What if $1,000 today could have the same punch as buying into the dot-com boom right before it took off? It might sound like a fantasy, but the blueprint for the next crypto supercycle is already being drawn up. We're seeing a mashup of two massive forces, unstoppable AI and a tidal wave of Wall Street money. That's setting the stage for a potential rocket ride to $250,000 per Bitcoin. In this video, we're going to break down exactly how this could all go down in 2026 and what the smart money is already looking at. This isn't just another wild price prediction. We're talking about a fundamental shift in the market, where the old rules are getting tossed out the window. Stick with me as we unpack the data, the key players, and the strategy that could define a new generation of wealth. Let's be honest, looking at the crypto market lately can feel like watching a highlight reel from a game that's already over. Those insane vertical climbs feel like a distant memory, and the current sideways chop can be, well, a little boring. You're probably asking yourself, did I miss the boat? Or, is this it for the cycle? The biggest pain point for investors right now is a crisis of confidence. But what if that whole perspective is dead wrong? What if we're not at the end of a cycle, but at the very beginning of something much, much bigger? A supercycle? This isn't just wishful thinking. It's an idea built on a blueprint that combines predictable history with brand new game-changing events. The foundation is something we know well, the Bitcoin halving. About every 4 years, the amount of new Bitcoin created gets cut in half, creating a classic supply shock. And we've seen this movie before. After the 2012 halving, Bitcoin's price went on an 8,000% tear. After 2016, it was around a 2,000% climb. And following the 2020 halving, we all saw it scream to its peak of nearly $69,000 in 2021. The 2024 halving has already happened, firing the starting pistol for what history suggests could be the cycle's most explosive phase, with a peak projected for 2025 or 2026. But this time, two new powerful pillars are amplifying everything. The first pillar is the fact that crypto is finally getting its Wall Street seal of approval. For years, the big financial institutions treated crypto like it was some weird, sketchy thing in a dark alley. That era is officially over. The floodgates opened with the approval of spot Bitcoin ETFs in the US. Now, that might sound like some boring financial plumbing, but its impact is nothing short of revolutionary. These ETFs are a secure, regulated bridge that allows trillions, yes, trillions, of dollars in institutional capital to flow right into Bitcoin. And we're already seeing it happen. In just a short time, these new Bitcoin ETFs have attracted massive inflows, hoovering up billions of dollars in assets. This isn't just talk, it's a clear signal of institutional FOMO. Think about what that really means. We're not just talking about retail investors on Coinbase anymore. We're talking about pension funds, endowments, and maybe even your neighbor's 401k getting exposure to Bitcoin. It's a brand new wave of demand coming from the most conservative corners of the market. This institutional flood is also happening at the perfect time. The broader economy might be setting up a huge tailwind. With the Federal Reserve projected to cut interest rates in the coming years, assets like crypto could look a lot more appealing to investors hunting for better returns. When money gets cheaper, the appetite for risk skyrockets, and crypto is often first in line to benefit. If institutional money is the fuel, then artificial intelligence is the high-tech navigation system optimizing the whole engine. This is our second pillar, and you could argue it's even more powerful because of how it's changing the game on multiple levels. First off, AI is rewriting the rules of how markets even work. AI-powered trading bots are now running incredibly complex strategies across hundreds of exchanges, 24/7. But it's not just about trading faster. These bots are making markets more efficient and providing deep liquidity, which creates a more stable launchpad for prices to climb. Analysts at places like Goldman Sachs have even pointed to AI as a key factor in making the whole ecosystem more robust. But it goes way beyond just trading. According to financial service experts like UBS, AI is set to completely overhaul crypto's infrastructure. Imagine AI agents that can write, test, and deploy smart contracts all on their own, or AI systems that can sniff out and neutralize network attacks before they even happen. This is the kind of stuff that accelerates innovation and builds a stronger, more secure digital economy, which, in turn, justifies much higher prices. This AI revolution is also opening up new doors for individual investors. For instance, There's a growing niche of people deploying their own AI arbitrage bots to catch tiny price differences between exchanges, offering a way to make money even when the market is flat. While some reports warn that AI could automate jobs, it's also creating new, highly specialized roles that are embedding these two technologies together for the long haul. So let's connect the dots. We've got the predictable momentum from the halving cycle, we've got the rocket fuel of institutional cash from the ETFs, and we have an AI co-pilot making the whole system smarter and faster. So, where are we headed? This is where the forecasts get really exciting. With all these factors converging, many top analysts are throwing out price targets that would have sounded insane a few years ago. Crypto analysts using models like stock-to-flow, and even experts at traditional firms like Standard Chartered and Bernstein, have suggested potential peaks for this cycle anywhere from $150,000 to $250,000 per Bitcoin. And for those with an even bigger imagination, people like Cathie Wood of ARK Invest continue to see a path to over $1 million per coin in the longer term. Let's circle back to our original question. What does this mean for a $1,000 bet? If Bitcoin hits that $250,000 mark, that's a massive multiplier from today's prices. A simple $1,000 investment could explode in value, turning a small, calculated risk into a sum that is genuinely life-changing. That's the simple math behind the supercycle thesis. All right, let's plant our feet back on the ground. A straight line up is a pipe dream. The road to a supercycle is paved with extreme volatility and very real risks. Ignoring them would be reckless, and a credible strategy means having a balanced view. So let's talk about what could throw a wrench in the works. First, the threat of regulation never goes away. A sudden, harsh crackdown on crypto exchanges,
Breaking news, the
or a new tax
SEC
plan from a
crackdown on
body like
crypto
the
exchanges is
SEC
causing
could
a
easily
massive
send the
sell-off.
market spiraling,
Bitcoin has
with drops of 50% or more. Second, a rough patch in the global economy could kill the vibe. A deep recession
Our
or a
data
major
indicates
geopolitical
that the
crisis
ongoing
could
crises,
suck all the money out of
particularly
the
in
market
these
right
zones,
when it's needed
are
most.
severely.
Finally, there are the market's own internal risks. Those AI bots that provide liquidity can also amplify flash crashes. And as the collapse of FTX showed us, hidden leverage and outright fraud can wipe out fortunes overnight. History shows that 80% drops are not just possible, but almost normal in crypto. This is why the #1 rule of crypto investing always holds true. Never ever invest more than you're willing to lose. Knowing the potential is one thing, but having a plan is what matters. So, how might a smart investor approach this with, say, that first $1,000? First, you'd build a solid core. This might mean putting around 50% or $500 into the big dogs, Bitcoin and Ethereum. If you buy them through a spot ETF inside a retirement account like an IRA, you could even get some nice tax benefits. Next, you could dedicate a smaller slice, maybe 15% or $150, to themes with higher growth potential. This is where you might look at some of the AI-related crypto tokens that are building the infrastructure we talked about. They're riskier, but the potential upside is much higher. To balance it all out, you'd keep a good chunk, say 20 to 30%, $200 to $300, in stablecoins or cash. This is your safety net. It lets you sleep at night and gives you the firepower to buy the dips when everyone else is panicking. The little bit that's left over could be for exploring things like staking to earn some yield. But honestly, the most powerful strategy for most people is dollar cost averaging, DCA. It just means investing a fixed amount of money on a regular schedule, no matter what the price is doing. Putting in $100 a month, for example, smooths out the crazy price swings and saves you from the stress of trying to time the market. Think about it. What if you had been doing that back in 2020? A small, consistent investment would have grown into a fortune by today. 2026 could be an even bigger story. We are at a fascinating crossroads in financial history. The combination of a predictable 4-year cycle, a fresh wave of institutional money, and the explosive growth of AI isn't just another passing trend. It could be the very blueprint for a crypto supercycle. The journey will be a roller coaster, no doubt, full of both risk and incredible opportunity. But for those who see the blueprint, understand what's driving it, and manage their risk with a cool head, a small bet today could become the foundation of tomorrow's wealth. The architecture is in place. The only question is who's ready to build. If you got value out of this breakdown, do me a huge favor and smash that like button. And make sure you subscribe so you don't miss our weekly updates as we track this supercycle. Now, I want to hear from you. Drop a comment below. Are we in a supercycle? Is $250,000 a realistic target? Let's get the conversation started.